Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, November 12th. The US dollar, Bitcoin, and Tesla continue to surf on Trump optimism, while energy and commodity related assets bear the brunt of sluggish Chinese outlook. And the Trump-phoria continues, particularly in the cryptocurrency space and Tesla, because Bitcoin added another 10% yesterday and came just shy of the $90,000 per coin level, while Ethereum flirted with the $3,400 mark. The crypto-friendly Donald Trump, who now says that the US should become the center of the digital assets, will probably remove the crypto skeptics out of the government institutions from their actual positions and simply replace them by crypto-friendly regulators who will then let the cryptocurrency industry thrive in the US. And when there's a comprehensive and a solid policy ground, then the banks could more comfortably integrate the cryptocurrencies on their platforms and hence could attract more institutional, more big money on board, and more demand would obviously push Bitcoin, which has a limited supply, remember, higher. So that's pure economics, that's economics 101. And so BlackRock's Bitcoin ETF has now more assets under management than its own gold trust, and eyes are on the $100,000 psychological mark for Bitcoin, and some people out there even pronounce higher price targets than that. So we will see where and how far Donald Trump and his new administration will lead the cryptocurrency industry, but we are bracing for more inflows, that for sure, and also more volatility in the foreseeable future. That's going to be quite fun, I'm telling you. And while the world is watching Bitcoin and the cryptocurrency assets valuations, which actually rallied more than 30% since last Wednesday, so it's worth watching it really. Well, Tesla is also printing a similar and even a better performance because the share price of Tesla gained 9% at yesterday's trading session and is up by 45% since last Wednesday. And I'm confident that Elon Musk, who is also a big Bitcoin fan, will realize his dream of accepting Bitcoin for Tesla sales sooner rather than later. And obviously, such developments are needed to add real substance to Bitcoin, which still needs more real-world use cases to drive organic demand, and that could eventually help trim some of the crazy volatility that we see there, which makes it obviously very interesting to trade, but much less so to spend. I mean, would you buy Tesla car for Bitcoin when you expect Bitcoin to double its valuation by next year? I don't think so. So there's still some way to go, but we're on the right path, that's for sure, with Donald Trump. Elsewhere, the S&P 500 consolidated gains yesterday near all-time high level, while small caps in the US extended their rally by 1.5% despite the rising US yields, which should at some point become a challenge for the US small caps as the post-election euphoria settles down. In the traditional currencies, which actually buy stuff, while the US dollar index is also pushing higher these days along with the US yields on expectation that Donald Trump's pro-growth policies and his tariffs would lead to higher inflation in the US and softer than otherwise monetary policy easing from the Federal Reserve. So that's obviously in contrast with the worsening economic and also political outlook for the Eurozone, with Germany these days preparing for a snap election on the German government's inability to tackle the financial difficulties in the country and revive growth. So you can see the misery in Euro's eyes, really, which tanked to 106.28 level against the US dollar and to 0.8260 level against the pound yesterday. So the German and the Eurozone economic sentiment indicators, the ZUI indicators, are due to be announced this morning and are somehow expected to print a slight improvement in November, but slight improvement per se won't be enough to lift mood in Europe, in my opinion, while the tariff threat from the US is taking a toll right now. So the Stoxx 600 index rebounded yesterday. It's rebounded probably on the expectation that a softer European Central Bank policy could boost valuations, but the ECB will probably remain more cautious than many expect when it comes to easing its monetary policy and rates because, well, simply because a rapid appreciation of the US dollar against the euro will have a boosting effect on the European inflation, as it will be the case for the global inflation, and that could eventually limit the European Central Bank's own ability to cut wholeheartedly. In summary, the things will be getting more complicated than many think right now. In Japan, for example, the likelihood of a further policy normalization is melting by the day, really. So there is still hope for the yen bulls that the Bank of Japan will deliver another rate hike in December or maybe in January. But to me, honestly, the December meeting is probably off the table for a rate hike, and even January is quite on a very, very slippery ground. Because one of the new PM, Mr. Ishiba's closest allies, so the Economic Revitalization Minister Akazawa, attended the BOJ meeting for the very first time, and he said that it's important for the Bank of Japan to continue monetary easing to ensure a complete end of deflation in Japan. Now, of course, this man is responsible for economic revitalization, and of course he has appetite for favorable monetary policy to boost growth, but the Bank of Japan has more does on board than hawks as well, and the rising global uncertainties now look increasingly supportive of the yen bears until a new FX intervention is triggered. So in plain English, that means that the dollar yen could push its advance toward the 160 mark before worrying about hitting a wall. And the soft Japanese yen, combined with the Japanese government's pledge to support growth in Japan, especially for the country's technology space, will remain supportive of the Nikkei index. Now, another place where the bears keep control in their hands is crude oil. The barrel of US crude kicked off the week on quite a negative note as worrying outlook for China, both due to the sluggish fundamentals in their home and the Trump's tariff threat, and the Chinese authorities' inability to meet the markets and investors' demand in terms of fiscal stimulus measures, and the idea that the Trump administration will drill baby drill sent the barrel of US crude below the $68 per barrel level this morning. Now, trend and momentum indicators have turned negative, and the RSI indicator suggests that there is still room for further sell-off in crude oil before the market hits the oversold market conditions. So the next natural target for the bears stands at the $65 per barrel level. As such, it is probably also just a matter of time for the dollar CAD to reach the 1.40 psychological mark. Elsewhere, the Aussie dollar is also bearing the brunt of falling iron ore prices on sluggish Chinese growth outlook. The pair actually gained last week on expectation that China would finally come up with something pleasant for investors in terms of fiscal stimulus measures, but that optimism remained capped by a major Fibonacci resistance last week and the insufficient stimulus package that was announced in China as well by the end of last week. So all that handed the market back to the bears, who are now tempted to send the Aussie dollar to 65 cents level at next stop. In other commodity-related assets, while the energy and mining-heavy FTSE 100 index was better bid at yesterday's trading session and could eventually benefit from a broad-based US dollar strength, but will a softer pound be enough to keep the FTSE 100 in the actual bullish trend is yet to be seen, because the sluggish China and the prospects of higher than otherwise global yields with the Trump presidency, as the US is expected to export its Trumpflation to elsewhere in the world, they all look unpromising for the FTSE 100. So the major support here to the past year's rebound stands a few points above the 8,000p psychological mark. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.